Good evening, everybody, and welcome back to Hurdle Rate. Today, we're going to do something a bit different. We're going to build an LBO model for Electronic Arts, which has just been, the other day was announced, was going to be acquired in a private equity style deal by the Public Investment Fund of Saudi Arabia and a couple of US firms, Silver Lake and Affinity Partners. So what we're going to do is we're going to build an LBO model. It's not going to be like the DCF that we've done in the past. They are a bit different, but yeah, you'll get the hang of it as we go along. So let's get started. So the first things that we do, as always, is we'll make this column a bit. Oh, it's not working. There we go. Yep. We'll make the A a bit smaller. We don't have to make B larger, and we don't have to freeze the panes, actually. We just need to take the grid lines off. And in the first, up here, we just put an X to show that it's the start of the start of a section, and take it to about M. Let's fill. So you're going to see a lot of similarities, but also things that are very different, such as the focus on EBITDA, different multiples, but it's and how the debt is structured on the deals. It's not something we've dealt with in the DCF, especially on the free cash flow to firm models that we've built so far. So these are our assumptions. So what we're going to do here, do about three columns, and fill, but put a bright blue here like this one, and keep the font, put the font to white. We need just a few sections here. So the financials here, we're going to want, so these are going to be the last 12-month figures. We want revenue, COGS, the cost of goods sold, the operating expenditures, depreciation and amortization, the net working capital, and the capex. So then, yeah, all good. Let's just put our, where is it? There we go. You might have to go on to get the dotted border. You just go into format, border, and you select this one, and you go these two, and there it is. Actually, let me just format the number as well. Always put the thousand separator on, and I usually use brackets for negative numbers. I think most people do. It just looks a lot cleaner. So we're going to want the. We'll come back and for this in a second, because we're going to take them from Yahoo Finance. Then we want the operating assumptions. Revenue growth, tax rate, and the year-on-year margin expansion. And these will end up being percentages. And we'll see what it comes, but we don't need it to be to any decimal places. Then copy this banner again and change it to entry. Change the title of it to entry. Let me zoom in a bit more for you all. And this is going to be the last 12 months EBITDA, the first line, the EBITDA multiple. Then we're going to have, just draw a line under this. Enterprise value, existing net debt, equity value, fees and expenses. And call this one exit down here. And this is going to be the exit multiple. So, okay. Then on the next bit, let's just do another one here. And this is for the debt. So how the financing for the takeover is structured. We want capital structure. Then this should be amount, interest. And I think they have there's 3 lines of 3 different forms of financing from coming from JPMorgan. The majority is going to be through capital provided by the private equity companies. I think that's 36 billion. Then the rest is provided by is through debt. But okay, but let's now look at the what do we want to do? So for this, we're probably we're going to say 10% growth. 10% growth here. The tax rate I checked it earlier is 26%. And I'm going to do a margin expansion of 0.25%. Okay, so for the financials, we are going to use Yahoo Finance. We go to Electronic Arts, and we can get the breakdown for the trailing 12 months of, so for revenue, this is saying 7,474 billion, 7,474 million. So let's just make sure that we know this is in millions. The COGS, the cost of goods sold, is 1,559. The operating expense is 4,433, 4,433. The depreciation and amortization is on the cash flow statement. And that is, where is it? Operating cash flow from, here we are, 355. Let's just do capex before we do the, okay, 2264 capex. Then the working capital, the way we're going to do this is, let's just get onto the balance sheet. It's going to be this, so it's current operating assets minus current operating liabilities. So 533 plus 382 minus 1306 plus 1334. Yeah, that's what we will do. Ooh, where is it again? So 533 plus 382, and just put that in brackets, minus 1306 plus 1334. Okay, yeah. So minus 1725. So basically, when we get onto the change in net working capital, if it's a negative net working capital, it usually means that they're getting paid before actually delivering the product. So yeah, let's go on to the next. Okay, yeah, let's just do the revenue build first. But before we do that, have another. So do a section called sources and uses, but we can't fill this out yet because we don't know the terms. But we'll make more space for that in a second. But we go financials now. Just copy this down. Oh, It's a bit silly of me. Okay, operating model. Just put year here, and we want to go 0, and just do +1 and take it all the way up to 5, like that. I'll just zoom out a little bit so that there we go. And this is now, this will feel familiar to you if you built the DCS with me. It's going through that same, yes, the same build out. So if we know, no, not this one, we go to year 0. We know the revenue is equal to 7,404 for the trading 12 months. And we're going to say that this will have a 10% per year revenue growth. So we put here equal to this box, and we just make them equal, pull it along, and we do the previous year multiplied by 1 plus the growth rate. Just format it and then pull it along, looking good. The next one is the COGS, the cost of goods sold, and this is how much it is to just produce the product, none of the selling or anything like that, just to produce it. And we know the COGS are. We're going to leave most of the rates stable, so let's see what this is. So the COGS are 21% of sales. Let's leave that as it is for the going forward, that we don't expect to see any expansion there. Just pull it along. The next one is the gross profit. And this is your revenue, and you subtract the COGS. Just so this has it's a huge gross margin, like nearly, what's that, 80%. OpEx, percentage of sales. What did we say they were? The OpEx is, yeah, here we go. And this is, as a percentage of revenue, 59.3. And we'll say that it's going to stay as that going forward. Okay. EBIT. So this is your operating income. And that is, do we have that up here? No, we don't. So we take the gross profit and we subtract the OpEx. And this gives us our EBIT. Pull that along. And then we need to see what it is as a percentage of the sales. 20% EBIT margin. The next one is the depreciation and amortization. Okay, equals, so it's about, well, yeah, nearly 5% or 4.7% of revenue. Keep that stable, then take the revenue, multiply it by the percentage of sales for depreciation and amortization. Yeah, and there we have it. Now we have EBITDA, and this is quite important because this is going to help us fill up here. So EBITDA equals your EBIT plus your depreciation and amortization. Pull that along. Well, actually, for this, let's forecast it a... No, we can't. Let's not do that because... Yeah, no, we won't, because we're not messing with either of these. No, we could, like, let's say there's margin expansion on the... where would it come? No, let's just keep it the same. Let's not overcomplicate things. There we go. Now this next one, the interest payment, we can't fill this in yet, and you'll see why later, but just leave it as that at the moment to remind us that it's going to play an important part. Then we have earnings before taxes, but after interest, and that just equals the EBITDA subtracted by the interest. Just let's get it set up now so that we're ready. EBIT. Then we have the taxes. There we go. And we know this is, I checked it, it's 26%. So we'll just leave it as that. We won't mess about with it. And we take the EBIT multiplied by the taxes to get our taxes paid. Then the net income, we want to see what this is, the percentage of sales equals we don't need it for the year 0 or the current year, we just need it going forward. Then you do net income divided by revenue. Pull it across. Okay, so that's the revenue sorted. Let's do some housekeeping up here. So we know last 12 months EBITDA is 1837. So put this equal to that. We know the takeover price is going to be 55 billion. So that's what we put as the enterprise value. So the EBITDA multiple is the enterprise value divided by the last 12 months EBITDA, and that gives us 29.94. But let's just customize this so that we don't do it like that. Okay, and we'll put the exit multiple equal to the entry multiple. So in 5 years, when they want to sell the company, they've extracted the value of it from it that they want, and they decide to sell it, they'll try and get the same exit multiple that they paid. And in this, it's 29.9 times, which is it's quite a lot. It's not cheap. And the net debt is, so cash 1518112. The debt is, where is it? 400 and then 1484. So let's do that. Because we're going net debt, it will be 400 plus 1484 minus 1518 plus 112. I didn't put in equals. Then the equity value is, we just do the enterprise value minus the existing net debt. And there we have it. And the fees and expenses for this are going to be, let's say, there'll be about $1 billion. And there's not really a way to fully clarify, but we'll go with that. The capital structure, from what I've read, is going to be, this is provided by JPMorgan. There's a term loan B. I'm doing this in terms of seniority. So the higher up the thing, and usually the lower interest rate, the more priority, so they get paid back first. So term loan B is going to get paid back first. Sorry, term loan B, revolver, and a revolver is like a credit card. It just keeps sort of high yield bonds. Then just copy these down. And we know this one's going to be 12 billion. The revolvers are 2 billion credit facility, and the high yield bonds are 6 billion. And the interest rate, we are sort of guessing here, but let's go with say 7% for this one. $7.8% for the revolver, and then the one that's paid last is the high interest. Is the highest interest, meaning it's taking the most risk, so it's getting paid last. And generally, if you're, because if you want to be paid back first, you take the lower interest rate. And this is so I don't forget later. IRR for reference. Okay, yeah. Now we go to let's do the cash flow items. And it's similar to how we've done before in calculating the free cash flow generated. Actually, okay, no, sorry. Let's undo that. Let's have a proper segment for it. So the darker blue. Cash flow items. We want the depreciation and amortization, percentage of sales. Then we want the net working capital as a percentage of sales. Then we want the change in NWC. And then we have CapEx. Yeah, okay. And this equals the DNA. Let's keep it up here. Even though you could also link it to here as well. It doesn't, it probably doesn't matter. Let's not. And we'll say that it, actually, no, you know what, let's just copy it. That's easier, especially when we come to update it. If we do, then the net working capital is, that equals, that we have to take from here. We need to know what it is as a percentage of revenue. No. Keep it consistent. And then the change in net working capital is the current year minus the previous. Just pull it across. Okay, that looks good. Let's go CapEx. Actually, we probably should have done it from the top, but for the depreciation and amortization. You've got to put it equal to the previous year, then pull it across. Otherwise, unless you lock in the cell and you just copy it. But yeah, otherwise it won't pick the right. Just go to format. Okay. Yep, perfect. Now we can calculate our leveraged free cash flow. Let's copy this. Come down. Leveraged. Leverage free cash flow, net income, DNA, CapEx, change in net working capital, and this gives us the leveraged free cash flow. Bold it all. Net income, take from here. The CapEx. Change in net working capital, it's this one. So then now the leverage free cash flow, it's the same as we've always done. So we use net income, we add back in depreciation and amortization, we subtract the CapEx, and we subtract change in net working capital. And then we pull that across. Sorry. We just pull that across, bold it. And actually, let's put a border around this. Okay. Now we have to do the sources and uses, and basically this is where the funds are coming from and what they're being used for, and it has to balance. So, oh no, not like that. Okay, yeah. Let's copy this. So this one is uses. We're going to need more lines. No, not like that. Sorry. How many do I need? No, more. Something like that. The first, okay. That's better. Okay, yeah, 2, 3. So we need amount. Underline it. EBITDA, how much of EBITDA is that? Or how many times EBITDA is that amount from of the funding? I'll show you that in a second. I don't really know how to explain it, sorry. So oh no, let's make it equal to, yeah, because we might update these to something else. So term loan B, yeah, there we go. The amount, then this is, so this, the amount, we go, yeah, just divided by the last 12 months of EBITDA, and we have 6.53x. Let's, and yeah, it's locked in. We can just pull it down. 1.1. And then we have, we'll sort out the percentage of capital in a second, because we have the debt, but then we also have the equity financing as well that we need to put in. So that's the money put in by the private equity firms, in this case coming from the PIF and Silver Lake and whoever else was involved in that. So total equals, and it's all, yeah, always check that this does equal what we need it to. So we know they're taking debt of 20 billion on, so that's so it's good, it adds up there. Then just pull it no. Then now we have, okay, just to add a couple more lines, we have something called sponsor equity. And we know that they're putting in 36 billion. And that divided by the last 12 months of EBITDA gives us the actually, no, sorry, I'm doing this wrong. Yeah. Okay, we've done that bit. We need to do the uses now. That is right, but it's not the right way around to do it. So this is the right way. We have to go into uses, equity payment. There's fees and expenses. Just copy these over. Underline them all just to be consistent. So the debt repayment is 1 second. Yeah, so we know the debt repayment is to pay off the existing debt on the company, and that equals, it's a small portion of EBITDA. Then the equity payment is the equity value, and that's the majority. And we know the fees and expenses are going to be about $1 billion on this deal. So we go total uses, and that is going to be, we just add everything up. There we go. And this, to work out the percentage of capital, we just see what it is relative to the total. Lock in K27. There we go. Perfect. Let's just put a grey box, and we'll get a box around this. We can make it a bit grey as well. I don't know. Total sources. Why do we need? Because we need to put in sponsor, equity, give me ones. Yeah, that's how we do it. And so basically these have to equal. So to work out what the sponsor equity is, we know what the debt is. To work out what the sponsor equity, what the private equity has to put in, we put this one equal to there. So we have our 56 billion there. Then the sponsor equity will now equal the 56 subtract 20, and that gives us the sponsor equity. Then to work out what that is as a percentage of as a multiple of EBITDA, we just divide it by that. And then for this, we just sum them up. So we get it the same. Then again, we just take all of these and divide by the total. So we have a percentage of capital. And then it's another way of doing our checks to make sure that we're adding up to 100%. Yeah, perfect. Looking good, looking good. Okay, now is, what is it now? I think it's the debt schedule. So okay, yes. Let's do the debt schedule. And this, okay, so this can be quite confusing, but we'll get there. Put it equal to term loan So the first thing we do is we'll do them one by one, but it will eventually be copy paste. So we go term loan B, then we go beginning balance, interest paid, pay down, and then ending balance. Pop a border on there. And also with these, just indent them slightly. Year 0. Okay, so we know the ending balance is, for the first one, it's this 12. Which means the beginning is going to be like this. Then we go to to pay the interest, it's going to equal the beginning balance multiplied by the interest rate on that loan. No, why did you do it like, sorry, 1 second. Multiplied by the interest rate, and lock that in. And it doesn't need to be a percentage, it needs to be a number. Oh, why are you doing that? That looking good. And then the pay down is, okay, how do we do this? We go equals min. We take that function and we select, it is, 1 second, let me just check that. Yeah, sorry about that. It's, okay, it is equals min, and it's the minimum of the beginning balance and the leverage free cash flow. And then the ending balance is, yeah, so now we then take the minus the pay down. You know what? I don't need the other side anymore. Let's make this larger. And we can zoom in. Oh yeah, that's better. Okay. Yeah. Now we just copy this over, and that is the first part of the have I got this right? 1 second. Yeah, we are, we're good. Then, yeah. Make that bold. Then we're going to copy this again. There are adjustments that we need to do because we order these in priority, in terms of priority. So the term loan B gets paid back first, then the revolver, then and what's the other one? The third one, the high yield bond. So the ending balance on this, on the revolver, is the 2 billion. And this hasn't copied properly. sort of know why. So we need to change this to M6 because it's a different interest rate. Pull it along. Four, five, four. Then it goes, and this needs to be min minus what we paid down before. Am I right? Sorry, 1 second. Let me just check that. Yeah, sorry. So we take, well, we know the interest is, it's M6. Copy that across. Then this one is going to be now, again, you do the min, you take this one, and then you take the levered free cash flow, and you subtract what has already been paid down. Yeah, you pull that along. Okay. Because this first bit hasn't been paid off, I think that's why it's not making a dent in this one. But when we see the total interest payment at the end of this, and we put that into the where we're calculating net income, you'll see then it will start to adjust and it will become a bit clearer. The high yield bonds, and what was the interest rate, did we say? 9%, and that's M7, this 6 billion equals we take this one, M7, pull it across, and now we've done 97. It's 101. No, but it needs to be 84. Still need to be the cash flow minus this down. So 1 second, let me just work that out. Yeah, sorry, it can get a bit confusing. So so it's this one, the levered free cash flow. So again, minimum, you do the 101 here, then you do it's the levered free cash flow minus the I91 minus this one here, and just pull that across. There we go. So because this tranche of debt has not been paid off yet, these can't get paid off. So yeah, that's why it's like that. Then we're just going to do a total, because this is how we find the full interest. Total debt. We know that at the beginning, so we just go sum. There we go. And then, yeah, this is what we're going to... So, yeah, we have all the debt here. Then basically we're just going to go sum, and the individual like this, put it across. Then we go the same with the interest. then the pay down. Then yeah, that's the ending. So what we'll do is remember that I-108, the interest payment equals I-108. Just copy this across. Okay, now you're seeing it all sync up. It's changing net income, it's doing all of this, it's going to change the free cash flow, and it affects how so it's all linked together. It's what do you call it? Yeah, like a circular flow. So yes, we've got that. Now let's oh, we're almost done. We're almost done. Awesome, awesome. We'll just do the IRR now. We don't need any of this. What we want to put, so last 12 months EBITDA at exit multiple, enterprise value, net debt, sponsor equity value. And we're going to work out the multiple on invested capital and the IRR. So we know the last 12 months EBITDA at exit is going to be up here, this figure. The exit multiple is going to be what the entry multiple was. Why isn't that working? Okay, yeah, it's good. The enterprise value is the last 12 months EBITDA at exit multiplied by the exit multiple. So 88.5 billion. The net debt we have here let's on these ending balances, you just bold them all so that they're a bit more visible. Then the sponsor equity value is you take the enterprise value and you subtract the net debt and you get 73 billion. Now, I've missed a line out. We want to know the sponsor value, equity value at entry. And that is going to equal, that's the 36 billion. There we go. So the return on the multiple on invested capital, you just do the sponsor equity value at exit divided it by the sponsor equity value at entry. So it's about 2x. Then the IRR is going to be, the way we do that is, it's very simple. We just, because we know it's been 5 years, so we take the multiple on invested capital, we do it to the power 1 divided by 5 minus 1. So we go to the power 1 divided by 5 minus 1. So it's about 15%. Let's use percent that. There we go. Remember that M122, M123. So we know up here now our MOIC, multiple on invested capital, is equals M122, and the IRR is M123. So equals M123, 15.2%. Okay, so there we have it. We've built out the LBO for Electronic Arts. And I know it's a bit complicated, and I find it complicated too, but it's sort of like, as long as like everything sort of sinks in, it's good. But I get it if it's one slight small thing wrong, and it can really mess it up. But yeah, that was quite interesting. I'm going to do more of. I'm going to continue doing the DCFs, the free cash flow to firm, free cash flow to equity. But I think it's quite good from time to time, and we can pick, say, public companies where we have the data for, and imagine what it would look like if there was an LBO to a leverage buyout to take them over or to take them private. So yeah, let's see if we get another chance to do one like that. This one I did because I don't know, the opportunity came because it was in the news. I thought, okay, that's quite cool to do. So yeah, okay. Well, thanks, and I'll see you on the next one. I'm going to watch the football now. Bye.